All right, let's talk about something that's kind of at the heart of our whole economy. It's one of those questions that, if you think about it too much, might just keep you up at night. What actually happens when a bank runs out of money?
Okay, so just picture this for a second. What if tomorrow, every single person walked into their bank at the same time, went up to the counter and said, "I want all my money, right now"?
Would the bank really have the money to give to everyone? And I'm not talking about a number on your banking app. I'm talking about actual, physical, cold, hard cash. Stacks of 20s and 50s right there, ready to be pushed across the counter? Well, the short answer, and this is the important part, is almost always a hard no. And that's because of a fundamental truth about modern banking. Something we all kind of take for granted but don't really think about. Banks, they don't keep your money. Which, leads to the real question here. What in the world happens when way too many people ask for it back all at once?
Okay, so if they don't keep our money, where the heck is it? Well, that gets us into what you could call the bank's big secret. It's all about understanding this powerful, illusion of deposits.
The system has a name. It's called fractional reserve banking, and it's exactly what it sounds like. Banks are only required to hold on to a tiny fraction of all customer deposits, just a small piece. And the rest of it, it's out there, being loaned out to other people and businesses. This chart makes it super clear. Let's say you deposit $1,000. See that tiny little slice? That's the reserve. Maybe $100, maybe less. It just sits in the vault. But the huge slice? That's your money being put to work, funding mortgages, car loans, new businesses. Your money is never just sitting there. It's literally funding the economy.
So what's the big takeaway here? It's that the entire global financial system isn't really built on gold bars in a vault. It's built on something you can't even see, something incredibly fragile. And that's confidence. It's just our collective belief that the money will be there when we ask for it.
Right. But what happens when that confidence just shatters? Well, that's when panic spreads. We're moving away from the math and into psychology now, because it's the human element that can bring a perfectly good bank to its knees.
And this is so important to get. A bank run doesn't start with some super complex financial analysis. It's not born in a spreadsheet. It starts with a simple, powerful, and very contagious human emotion: fear.
And that fear, it can be sparked by pretty much anything. A rumor that the bank's in trouble, news about a really bad investment, even just general economic anxiety, or, and this is a huge one today, a single social media post that goes viral and spreads bad info like, wildfire.
This is where it gets really dangerous. The fear that the bank might fail makes everyone rush to pull their money out. But remember, the bank doesn't have all that money on hand, so that sudden demand for cash is the exact thing that makes the bank fail. The fear literally creates the reality. It is a perfect, and honestly, a terrifying, self-fulfilling prophecy. All right, so the prophecy comes true. Panic is in the air, the lines are wrapping around the block. What happens now? Let's break down exactly what goes down, step by step, when the money starts to run out.
So, the bank basically has a 3-step playbook for when things go south. First, they try to slow the bleeding, right? They'll put limits on ATM withdrawals, maybe slow down wire transfers, anything to buy themselves a little time. If that doesn't work, we move to step 2, emergency borrowing. They're on the phone with other banks, with the central bank, trying to get a cash infusion. And if the panic still doesn't stop, that's stage 3. The government steps in. Regulators take over, they might freeze accounts, or even force another bank to buy them out just to stop the chaos.
Now you're probably thinking, hang on, what about deposit insurance? Isn't my money protected? And yes, it is, but. And these are 2 huge buts. First, that insurance has a limit. In the US, it's usually $250,000. And second, getting that money back isn't instant. You don't just walk in the next day and get a check. And in a real crisis, waiting even a few weeks for your money can be, pretty devastating.
And here's the thing. This kind of panic, it's not just a problem for that one bank and its customers. It sends shockwaves through the entire economy. This is the fallout. This is why one bank failing can end up affecting, pretty much everyone.
It's like a domino effect. Just think about it for a sec. All the businesses that use that bank, suddenly they can't pay their employees. The credit markets just seize up. No more car loans, no more mortgages. The stock market, of course, goes into a nosedive. And maybe the worst part, that public trust we talked about, poof, it just evaporates.
There's this quote that I think just nails it. It says banking is the bloodstream of the economy. And when it clots, everything slows down. It's such a perfect metaphor, right? It's not just about your savings account. It's about the vital flow of money that keeps everything moving. When that stops, we all feel it.
Okay, I know what this sounds like. It sounds like something out of an old black and white movie. You know, people in hats lining up outside a bank. It feels like ancient history. Which brings us to probably the most important question of all. Could it happen again? And if you look at history, the answer is a pretty clear yes. I mean, you've got the Great Depression with widespread bank failures. You've got the 2008 financial crisis, which was basically a global cash crunch. And we've even seen major regional banks fail just in the last few years. So no, this is not a relic of the past. The pattern is there. Our systems are definitely stronger now, but no system is completely panic-proof.
And this, I think, is the key thing to understand for today. The real risk isn't that your money just disappears forever. Poof, gone. The real risk, the much more immediate danger, is that your access to it disappears. The whole system just freezes up, and suddenly that balance in your account is just a number on a screen that you literally can't touch. So when you really look at all this, you start to realize maybe we're all asking the wrong question. Maybe the question we should be asking isn't, will it happen? The real question is, would you be prepared if it did? If the system froze up tomorrow and you couldn't get to your money, not forever, but just for a week, maybe two, would you be okay? Now that's the question we're thinking about.